The world is changing fast, and so are the local real estate markets. Don't worry, though. We've got you covered. Welcome to the Real Estate Revolution.
This is The Revolution, the Real Estate Revolution podcast. I'm Kip Lohr, your host with Lohr Real Estate, and we have an amazing show for you today. We have Kat Woodman with Impact Investors in the studio today. And, you know, in previous episodes, we have talked about how influences such as rising interest rates, inflation, fluctuating stock market, and low housing inventory continue to create an uncertainty in our financial markets. And so, you know, we're bringing Kat in today. She is a certified financial advisor. They have a fund of their own, and they also do portfolio management. And so she is in the financial world. And I thought it'd be great to get her take on what's going on with them, what they're seeing in the markets. So essentially, they're kind of looking at the lens of the financial world through the stock market and the bond market and places to put your money in socially responsible ways. And we will get her on the show here in a few minutes. But as always, we have to start out the show with our weekly market report with Ryan Neal in our Eugene office. Take it away, Ryan Neal.
Here's our weekly market report for the week of March 21st, 2022. In Eugene, we're finally starting to see a bit more inventory coming onto the market, but I really do mean a bit. During the past week, new listings came in above pending sales for the first time this entire month. And normally, you know, we'd start to see more listing activity coming in toward the beginning of the busy spring buying season, but that just hasn't materialized yet. But we're starting to see some signs that things may be picking up. It may be a while, though, before buyers experience any more choices than what they have right now. Things just feel really tight. Most notably, what we saw last week was that activity was really weighted in Eugene towards sub $400,000 properties. Pending sales were listed at a median of just $397,000, and that's way lower than the prices that we've been seeing. So what gives? Simply put, Eugene's most desirable inventory is selling fast. It's fetching multiple offers and going way above list price. We all know the story. But there's a big chunk of inventory that's sitting on the market longer. And there are plenty of homes, especially at these higher price points, that just aren't as palatable to buyers. So there's still plenty of sellers in Eugene who are overpricing their homes. And we keep mentioning this, but now it's more important than ever before to price your home correctly. Otherwise, even in the market that we have right now, you might end up sitting on the market and, you know, having to make some compromises as far as final price. In Springfield, inventory is up slightly, but it's still even lower than it is in Eugene. Right now, the supply of $500,000 plus homes is extremely low. There's only 10 of those available right now. Now, there are plenty of people who do prefer to live in Springfield over Eugene, and there's continuing to be a lot of competition for these properties toward the higher end of Springfield's market. In Bend, sale prices for the past week spiked way up to $827,000 median. That's a reflection of the offer prices we were seeing in February, really, rather than anything that's happening more recently. Like we've been talking about the past couple weeks, you know, pending sales numbers are down a bit from, you know, those super hot numbers that we were seeing in February. Last week's pending sales were listed at a median of $677,000, and buyer activity continues to be strong at the lower half of Bend's market. There is more inventory coming on at the upper end of the market. Last week's median list price was $825,000, so we're starting to see more homes getting listed toward the upper end of Bend's market. Inventory is still pretty low in Bend historically, but we're starting to climb back up as we enter into the traditional selling season right now. There are more than 174 active listings currently in Bend, and that's compared to about 150 last week. So starting to see a trickle of new inventory into the market. In Redmond, sale prices are pretty much comparable to what we saw last week. But there was a significant drop in both buyer and seller activity, just 15 new listings and 11 pending sales. We're not seeing this as any indication that Redmond's market's slowing down. It's just kind of a blip, kind of coincidence, really. Sales are still weighted toward the lower half of Redmond's market. The median pending price is $499,000 right now. The inventory that is available is weighted toward the upper end of the market. It has a median ask of $650,000. And like we've mentioned during previous weeks, Redmond traditionally seen as a lower cost alternative to Bend, but depending on what price point you're looking at, you may or may not actually be able to save very much money in Redmond. That does it for this week. Let's continue with the rest of our show after a very short break.
Welcome back to the Real Estate Revolution podcast. I am Kip Lohr, your host with Lohr Real Estate, and it's time. I promised you earlier in the show we would have a great guest, and we absolutely have a great guest in the studio today. Her name is Kat Woodman with Impact Investors, and I'd like to say hello to you, Kat. How are you today?
I'm good. How are you doing?
I'm doing great. We've been trying to do this for, 2, 3, 4 weeks now, trying to get you into the studio and talk to you about what's going on. I mean, we have had several episodes, in the last few weeks where we've kind of been talking about, the shifting sands of the markets and whatnot and how that affects the real estate market. And I thought it would be really a great opportunity to bring somebody who's in the financial advising / portfolio management kind of milieu to kind of come on the show and talk about what you guys are seeing from your angle. And on top of it, we helped you and your cute little daughter move up from the Bay Area. Gosh, how long ago has it been now?
About a year and a half, a little over a year and a half.
Wow.
Year and 3/4.
God, really? I mean,
yes.
that blows my mind away a little bit. It feels like we were rolling around not that long ago, trying to find you a place. But
it's the pandemic. Everything feels both short and long. all at the same time.
That is so true. And so I'm hoping that we'll start the show by kind of talking about the markets and what you do and have you give some insights into the shifts that you're seeing in the markets and how you're helping your folks kind of ride that wave of those shifts. But then I hope we can talk about, what it's been like a huge, bold move to pull up stakes and move you and Delilah north to Eugene, Oregon from the Bay Area and kind of start life anew a little bit. I mean, I guess that's part of the gypsy lifestyle of being able to be a remote worker these days, right? So,
right.
Don't let me forget to ask you a little bit how it's been. And I had no long it's been that long. So I guess getting caught up is really probably a good thing. So anyway, you are with Impact Investors. You are an owner of the company, correct?
I am. Yeah, I'm a 50% owner.
Okay. And so tell us a little bit about you and your company.
Okay. Well, I got into this whole racket in my late 20s when I was trying to figure out what I wanted to be when I grew up. And I came across a book about socially responsible investing. And for me, it was just the idea that possibly a transaction could happen and it could mean something good happening in the world instead of, something traumatic for the world happening. And that was basically the spark that led me to become a financial advisor. And that was in the year 2000, which, if anyone remembers, the dot-com bust was
100%
a perfectly terrible time
right.
to start in the market.
Yeah.
But it was great because I learned mostly through other people's errors during that period of time.
Yeah, the smart people can actually learn from other people's mistakes.
Yeah, hopefully.
Right? Yeah.
Totally. Hopefully so.
Yeah.
So then, I started in this business of being both a financial planner and financial advisor and managed my own portfolios. So then it was 2007. That was my turn to really see how my portfolios did during the major downturn.
Right.
And it was definitely eye-opening. Somewhere between eye-opening and traumatic to be like, this is a diversified portfolio. It's supposed to do what I want it to do.
Right. And everybody got hammered. So it wasn't.
Everyone got hammered.
But it wasn't you, Kat.
I know. But of course, everyone I ran into said, oh, of course, like it was obvious. I saw it coming. I think it was pretty obvious. My dad said that to me.
Really?
Dad said.
So
yeah,
what you're saying is he cashed in and made a bundle on the downturn in 2008?
No, I don't think so. I think
right.
he was like, pull me out of real estate. But anyway, long story short, that was an educational experience. And then, so I've mostly been a singleton. I've mostly sort of run my own practice until about 7 years ago. I purchased the business of a woman who was retiring and then met up with a gentleman who was to become my business partner. And at first I hired him just to do some consulting for me. And then we really hit it off. And so he came with the Impact Investors moniker.
Got it.
And so we merged in early 2017. And that's when we became business married.
Wow.
And it's been really great. Yeah.
Yeah. So for folks that are not familiar with impact investing or socially responsible investing, kind of help folks out there have an understanding of what it is that's different about what you guys do than any of the other firms out there.
Yeah. Well, the basic gist is that we're trying to invest with people's values. And so most of the values that most of our clients have are along the sort of liberal edge. There are also socially responsible investments out there that are more Catholic leaning or more Christian leaning, but those of ours tend to be more about environmental responsibility and social equity, social justice, that kind of thing. So it's really doing whatever you can do in the world of money to try and further those values. And there's a whole range of things that can be done either further upstream or more in public markets or more in community investment. There's a wide range of things that you can do and things that you can invest in, but it's really trying to both make money and still become retired while also doing as much good as you can possibly do at the same time.
Right. Which I think for most people would be like almost antithetical, right? Where it's like, capitalism is bad. And if you're making money, you've got to be making it on the backs of other people, stepping up the ladder, which there are parts of the capital markets that definitely operate that way. But, green energy is a great example, right? Where there's companies that are environmentally conscious that are putting a lot of entrepreneurial effort, yes, into, making the planet a better place. And once there's a market for it, then people can make money, right? Like one of the things that I talk about with my clients sometimes, because the real estate market is another one of those markets where people are like, you're doing this on the backs of other people and making it unaffordable to a whole segment of folks. And there is truth to that, but there's also this other side of things where capitalism can, like, for instance, you can go down to Costco of all places and buy organic produce today, right? And you couldn't have done that 15 years ago? You create a market where the initial impetus of that is to do something good for the environment and provide something that's going to be more nutritionally sound for people. And then all of a sudden, when there's a market, then people jump in and there's money to be made. So I understand that, but I think it's interesting that a lot of people have a hard time grasping that.
Yeah, I mean, basically, if you sort of swing wildly from either end of the spectrum, to me, it doesn't make a lot of sense.
Right.
And I've seen it both ways. I've seen people say, there's no way you can make money while also trying to do good things. So you might as well just make as much money as you can. And then when you retire, you can donate part of it. And that's the argument on one side of things. And then on the other end, I've met people who said, well, I put all of my money into renewable energy and then it tanked. So I put it all in GE, which is whoa, there's a lot of middle ground. We're always trying to find the middle ground. Like, how do we get you retired in a balanced portfolio while also doing as many responsible, both from the fiscal side of things, as well as responsible from the social and environmental side of things at the same time. That Venn diagram of what's the middle.
Yeah. What's the middle? And so you were telling me off camera, we're not on camera, but off the air, that what you guys do is a little different. You're kind of financial advising services. You also have a fund that you have started, correct?
So we are financial planners. We're all CFPs, certified financial planners. So we help people with just answering the questions that have numbers as answers, like how much should I be saving and when can I retire and all that jazz, as well as managing our own in-house portfolios. So there's just a lot of advisors in the world who do kind of one or the other. And we do both of those things mostly because of my own hubris. That I have a way, I have the best way, nobody else will do it my way. So we're just gonna do it my way.
So this kind of comes from a control freakiness, right?
I guess, like I mentioned that I had, 2007, 2008 were really harsh, and I did a lot of research and studied a lot of academic journals and found there were several styles of investment theory that really did protect more against downside risk. And I didn't find anyone who was out there doing both socially responsible investing and this theory, which is called risk parity, basically.
Got it.
And it's Ray Dalio and Bridgewater and blah, blah, blah. There's people who do it who are not focused on socially responsible investing, but I wanted to do both. I wanted to have a really diversified, really defensive portfolio at the same time as also having it be as socially responsible as we could possibly make it.
So you wanted to have your tofu and eat it too.
I did. I did. I wanted both of those things. And I did try finding third-party managers where I asked, can you manage it like this? And they said, no. And I was like, okay, well, I'll make it myself. So there's that part of managing our own public portfolios. And then also we were mostly from the call of our own investors who said that they were willing to lose money to take a risk in order to really invest in something that they were really excited about.
Yeah.
And we said, well, you don't have to lose money.
Right.
We can do this in a really good way. And so we started our own private investment, so we're in a space that's really unusual because we're an RIA, we're a registered investment advisor shop, and we're not like a billion dollar pension fund,
right?
But we're still creating this fund for qualified investors who can invest in these really cool, high impact investments that really do have a tangible effect on the world. It's not so much like, well, we aren't investing in Facebook or we aren't investing. It's not just like minimizing damage, but full on investing in things that really are improving people's lives. So it's something that I'm really excited about.
Well, so the current state of the world obviously has shifted in a way that we're seeing inflation, we're seeing possibly bubbles in certain segments of the markets out there. How is what is currently, going on right now affecting the way that you guys go about helping people financially plan right now? How does it, as far as the recommendations of where to put their monies to invest them, what are you seeing right now, and how are you guys coping with kind of the shifting landscapes?
Yeah. Well, as you mentioned, having rising inflation like we have not seen in a really long time.
Yeah.
I mean, to me, it's amazing actually that it took this long to see this kind of inflation.
Totally.
Because people were saying that this is what was going to happen for a very long time before it actually happened.
Yep.
And then interest rates are rising is just what's going to be needed in order to control that inflation.
Which is happening.
And then, of course, you have the war in Ukraine as well.
Yep.
So it's a lot of uncertainty. It's rising interest rates, which a lot of different asset classes don't really like. But for me, I mean, the whole thing just tickles me a little bit just because I have basically been saying, these valuations are so high, they can't possibly go much higher. And
right.
I've been saying that for 4 years now.
You've been wrong for 4 years. Yeah.
But, also like I was around during the bubble, and I remember listening to analysts talking about the real estate bubble in 2004 and 2005. And they were saying exactly things like this. They were saying, well, according to our models, there should have been a bust years ago.
Right.
And it hasn't happened. So, So luckily, I never totally believed my own press. So I just think like the question's always like, well, what if you're wrong?
Yeah.
So making any big dramatic moves, almost no matter what's going on, usually hurts you, depending on how you're already invested.
Right.
So we were already in fairly defensive portfolios because of these really high stock valuations that you still see. There are very few economists that you listen to these days who will say, oh, yeah, you should expect really high returns in equities in the next 10 years. You're not going to hear a lot of that.
Right.
Just because everyone else is looking at the same chart that I'm looking at and saying, how much upside can there be here? People are paying so much just to own the stocks they have right now.
Right.
So, and that's where a lot of the growth is in the economy. So there are places to be, but, there's not 100% escape from, there's no such thing as a no risk version of things.
Right. And historically, the stock market in particular it trends up, right? So, it has its peaks and its valleys, but Look at what happened in 2007, 2008. The real estate market, the financial markets crashing, obviously affected the stock market pretty dramatically as well. And the stock market was the first thing to rebound, which I thought was a little nuts. But what I found in my own personal experience in being in real estate was this was the first time for most people that they had to actually think about their personal finances. Most of the people up to that point really didn't understand how money worked. And then when they ended up losing their homes, they had to be cash and carry. They couldn't borrow money. They couldn't get a credit card. They couldn't borrow money for a car. They couldn't borrow money for a house. So they were in cash and carry mode. And there was also a lot of feeling like they were not good people. I've lost my house. I signed a contract saying that I'd pay this money back, and I didn't. And so it took about 5 years for people to get back on track. And in that 5 years, they really learned how to manage their money in a way that I think was almost historic for this country, as far as the number of people that were able to for me to be able to buy capital things, bigger things, I've got to be able to put some money away. And to do that, I've got to be able to know what I'm spending in the first place. And that really created this new, more conservative, more thoughtful way of borrowing money for a lot of people. And we've gotten a little bit away from that for some folks, but I can tell you a lot of the folks that I help right now, they have not pulled a ton of equity out of their houses, even though it's gone up dramatically over the last 3 or 4 years. And so, we're in a stage where people are like, the sky is falling a little bit, or the real estate market's got to pop at some point, and the stock market's got to start heading downward. But I feel like fundamentally, just in my guts from the real estate side of things, people are just smarter about their money than they ever used to be, just kind of on the working man and woman part of the population where they weren't necessarily as savvy before the market crashed. And it was a deep psychological wound for a lot of people.
I hope I don't hope for wounds, but I hope that you're right that a lot of people learn things. I work with a lot of different people, and some people kind of get the financial planning side of that, the kind of cash flow side of that, and some people don't. I think it's really case by case from what I see. And it doesn't matter how much you make. That's what's been sort of a lifelong surprising lesson to me, which is that you can have a couple that makes $500,000 a year, and they can be living very much paycheck to paycheck.
Yeah.
And it could be almost dire at any given moment. And you can have somebody who's making $40,000 a year who's just living in a style where they'll be fine, no matter what happens.
Totally.
So,
and that's kind of what I'm thinking, what I have seen is kind of like that middle America, that middle class of our economy. Almost everybody in that part of our economy got hurt and had to learn a pretty hard lesson. And I can just speak only, from my own experience, but most of the people that I work with, I do get what you're saying. There are definitely folks out there that are, living paycheck to paycheck, and they make $500,000 a year, which most of us would be like, how in the heck do you do that? But you
sign up for a lot of things.
You sign up for a lot of things. Yes. You're drinking a lot of $500 bottles of wine. But yeah.
And private school.
And private schools. Yeah. Well, or you live in the Bay Area. And some of this is just, it depends on where you live. It's all relative, right?
Absolutely. Well, I was going to say, the interesting to me, the very basic thing, the seed of what you were saying that people learned is kind of that basic idea of cash flow, which you see in Kiyosaki's book, Rich Dad, Poor Dad. And Ray Dalio has this great video called How the Economic Machine Works, which is so great, where he talks about, the dangers of credit, how credit really works, that it works to kind of multiply the amount of money that's out there because of credit. And then exactly the opposite happens during a recession, whereas it's like all of this liquidity just can disappear, and
almost overnight.
The impact that has.
Yeah,
almost overnight.
Yep.
So I think that at its core, I think people who understand that lesson aren't going to get themselves into too much trouble. I think
Yeah. Since '08 for me, I have been able to, get folks, because we specialized in doing short sales when the market crashed. That's kind of how we stayed above water. And we ended up doing, just in Bend, Oregon, we ended up doing over 350 of them. And
oh, that's so sad.
It was. And at the same time, it was probably the most gratifying work that I've ever done in my life, because, it was at a time when we were coming in and being able to help guide people through what they thought was something that was impossible. They're underwater by $100,000, and what am I going to do? And we got them on a path to being able to get the bank to forgive that and for them to move on. And in a way where they could start sleeping again at night and start licking their financial wounds. And we had marriages that were on the rocks because of this. And we had, people that were literally on the edge of suicide with this, and to be able to go into people's living rooms and say, hey, there's a pathway forward for you. And it's going to suck up front. It's going to affect your financial life, for the next 4 or 5 years, but it's going to take that heavy weight that you're feeling right now off your shoulders. And I was able to get many of those people back into homes once they got to the point where their credit had recovered from doing a short sale. And
great.
Straight across the board, it was like this revelation for them where they were going to be 20% down. And, their financials were super solid by the time they were ready to buy again, in ways where prior to the crash, it was just, you could be 0% down. You could have stated income loans where, if you're self-employed, you could pretty much just tell the bank that you made anything and they would lend you money. And the money was so easy to get. And the music was playing such sweet music that people thought that it would never stop, right? And when it stopped, there were no chairs to sit in,
Yeah.
The whole room of people had no chairs to sit in. But at the other end of it, I guess I feel a lot of optimism from, we're just close enough to what happened in 2007 that I think that people's memories, they still are remembering that, and they kind of guided their finances in a way that I feel like the fundamentals, I guess I have some faith in, as far as kind of that middle of our population, the middle income folks.
Yeah. And so the people who were in trouble, who were underwater, was that mostly due to people, treating their houses like a piggy bank and taking out HELOCs and so forth? Or was it really just the drop in the market that was doing it, or a combination?
Oh, it was all over the map. So in Bend, Oregon in particular, because it was one of the markets like Las Vegas and Phoenix, Arizona, of all places, like these were like 3 of the worst hit markets in the entire country, where the property values dropped by more than 50%. If you can even imagine that, right? So clearly, unless you kind of owned your place outright, you were going to be affected by this thing. So everybody was kind of affected. But then there were people that in the run up for it in Bend, it was a speculative market. We had a lot of people coming in from out of area that were buying new construction. So they buy a house, let's say $300,000, and it's going to take 4 or 5 months for the construction to go. In 4 or 5 months, the construction's done, and then they immediately sell it and make $40,000 or $50,000 in the course of, 4 or 5 months. And there were enough people doing that they were doing like 4 or 5 or 6 of them at the same time. Right. So there were those folks that were kind of speculating. And then when the music stopped, they all got wiped out. In fact, the first short sale I ever negotiated was with a guy that had 6 of these that he did. He was a lender at Wells Fargo, and he had borrowed all of his money from Wells Fargo, the place that he worked. And so we're negotiating essentially with his employer to basically wipe out these 6, loans that he had on these things. But there were also tons of people that, had no skin in the game day one. They were getting 0% interest or 0 down loans. So they had a little bit of equity maybe that they had built in, as the market went up, but you can't recover from a 50% drop if you didn't start out with any money in at all. Right.
Right.
So, kind of any of the scenarios you could possibly imagine, we saw all of the different versions of it.
Oh, wow.
And some of the most painful for me were ones where, I had a lender friend that she had 2 homes, and because she was in the industry, she was not going to be delinquent. And so she went through all of her savings, making her payments. Then she pulled out all of the retirement that she could pull out and made her payments. And then she ran out of money and lost them anyway, to the tune of about $300,000. Right.
Aww.
So made the payments until she couldn't and went through her entire retirement. And so one of the things that I feel really good about is we were able to help people get to a place where they could get out from underneath these homes and not completely wipe out their retirements and be starting from, square one again. I just feel like, historically we've seen these up and downs, and we're in another one of those kind of historic moments, but 2008 was a pretty big deal, kind of straight across the board.
Yeah. And what do you think about now? Because, I just had a neighbor who was saying like, well, we're in another real estate bubble. And I was like, I kind of don't think so. I mean,
right.
If there's a recession, the value of all assets will fall, but that's different than a real estate bubble. You know what I mean?
Yeah, no, I totally agree. And I think that what I can say is that the markets in the Eugene Springfield area, well, throughout the whole country that have hot markets, they're not hot. They are white hot. They are like scalding lava coming out of the volcano hot. They are, and I agree with you. Does that mean it's a bubble? And I think that, for me, it's a reflection of the lack of inventory. It's basically the easiest economic concept for everybody to understand is supply and demand. And it's a supply and demand issue. And, interest rates going up is going to lower the demand to some extent, but it's not going to be enough to, extinguish enough demand to have it make a major shift in the market, at least for the next year, I think. Even the big boys, Zillow, CoreLogic, they talk about we're going to get to a more normal kind of like 4 or 5% a year increase in value. I mean, would you be bummed out at a 4 or 5% return on your money right now? I mean, I wouldn't.
No.
Right?
I mean, and certainly historically, that's been the wrap on real estate is that you can expect sort of inflation rate returns over time.
Yep.
That's what the normal has historically been.
Yeah.
So.
And I guess the thing for me in real estate investment is really, it's about cash flow for me. And I know you and I have talked about this before, but when you're, so like in 2008, people who owned real estate, their portfolio, let's say they own their house outright, their portfolio, their house, the value was cut in half. But if they were renting that house out, the rent actually went up. So even though the value of the home went down, the actual cash flow went up. And so for me, there's definitely a place in people's portfolio to have some real estate in there from a cash flow perspective without having to be looking at it from a standpoint of like, I need a 5 or 6 cap on this thing to have it make sense.
Yeah, absolutely. Just having the diversification. I mean, as many different asset classes that are, that make sense is helpful. I'm laughing in my head because I did hear an investor. It was an entrepreneur who was presenting their business idea, which was to be able to sell stocks, like basically a sliver of ownership in tennis shoes and like rare tennis shoes.
Okay.
And there was a really large segment of the people who were hearing this that were like, this is great. This is wonderful. And I'm like, don't these things just disintegrate over time? Don't tennis shoes disintegrate over time?
Yeah.
And for me, I just felt like maybe I'm too female, too white, and too old to really, truly appreciate
hop on the
it.
Sneaker market to be throwing that as part of your portfolio is throwing some sneakers in the. Well, I guess
there was part of me that was like, this is the sign. This is the end of time.
This is the end of times. People are like, they're sneakers are as an asset class. You're
sneakers
like,
as an asset class.
That's
like
right.
we are. This is the fall of Roman Empire.
I need to tap out right now. Yeah. Well, I mean, that's not any different than like people who collect stamps or rare coins or baseball cards. When there's a perceived value. I'm totally like sidetracking here, but the Tom Brady retired. You know who Tom Brady is, right?
Yeah.
Quarterback for the Patriots.
Vaguely.
Well, he was the former quarterback. Well, anyway, he retired, and the last football that he threw, his last touchdown pass that he threw.
I think I heard about this.
This football ended up selling for like $500,000, and then he just came out of retirement.
And then he came out of retirement then like a week later or something.
It was in the same week. It was in the same week that this thing went for auction for like $500,000 or something like that. And so, Yeah, it's to some degree, it's all absurd. It all will be dust someday, and it's just some of it will be dust sooner than later.
Right.
But
NFTs and
so
all that stuff.
I don't know if we got off track or we're completely on track, but I mean, that's the fun thing about these kind of interviews is we just kind of can rap about, some really interesting topics that I think folks out there that'll be excited to hear some different perspectives about. But as far as like the markets and impact investing and your company Impact Investors, is there anything we left out? I mean, we're probably 10 shows, couldn't cover it all, but is there anything that we need to cover that we haven't covered, do you think?
I think we've gotten the basic gist. I think
basic gist?
I mean, I think I would just say in terms of our portfolios, I just really believe in true diversification. And I just think it's among financial advisors. First of all, financial advisors as a group, as a just very general group, don't tend to care as much about the social and environmental good. And maybe that's a shocking statement to say, but when investors have been surveyed on, especially women investors, especially younger investors, care a great deal about the impact that their investments make on the world.
Right.
But financial advisors, the last statistic I saw was a little old. I think it was at least 5 years old, but it was like 7% of advisors actually gave any kind of crap about socially responsible investing or having a positive impact with their money in any way. I just think it's something, to me, that seems just pretty obvious. And it is finally kind of having its day. And that that's the case because there's all of the large players out there are now starting to, have their socially responsible mutual fund, or they're buying up a lot of socially responsible companies so that they can have this in-house department that does this, because they're finally figuring out that, oh, these people are serious. Like,
right.
Oh, these kids who are inheriting all this money, they actually do care about this stuff. So,
well, it's organic produce, right? Like you can get it in Costco today. 20 years ago, you had to go to the farmer's market or grow it in your backyard. So you guys are just the organic produce of the financial markets, right? You guys are early adopters in something that, back to the original thesis here, right? Like if there's a profit center and it's a decent one, people are going to hop on. And then once you got enough people hopping on, then you become more competitive with more traditional investments.
Right. And the bigger sort of players out there can kind of talk the talk,
Right.
So you do have to be careful because there's no such thing as purity in the financial world.
Right.
Nothing is black and white. It's all shades of gray.
Yep.
But, when you do have these big players that are like, oh yeah, we are socially responsible. And then, and then you look at their investments and you're like, you're really not, and I've been doing this for a long time, which doesn't mean that I'm the best or know everything. It just means
Kat, you're the best. You and all of your folks at Impact Investors are the best. But
it does mean that I've been committed for a very long period of time. And I had a client's other advisor say something to me like, well, I know this is really like chic right now. And I was like, I'm going to reach through that phone.
I've been doing this for 20 years, you jerk. This will be my
22nd year in August.
Well, you could say, well, I have been chic for 22 years.
I know.
And you're just now getting to be chic, So,
I guess so.
Yeah.
But I did it back when I was told by Smith Barney and the big brokers, like, you can't build a business on this. This can't be the only thing that you do. And luckily, I might have believed that because I was in my 20s and 20-year-olds believe a lot of things. But luckily, I had met some other advisors who were already doing it.
Yeah.
And I was like, no, I've seen examples of success. I know it's possible. So,
well, for better or for worse, we are a culture that if it ain't broke, don't fix it. Unfortunately, right? Mm-hmm. So there's a lot of issues in the world right now that are getting to the place where they're broken, and broken in a really profound way, that are going to take some very fundamental shifts in sensibilities and fundamental shifts in the way we do business, just globally and also locally, right? And so in a way, you guys are positioned in a part on the economic side of things that your day is here. I think maybe you were chic for the last 22, but now you're fundamentally necessary, right?
Yeah.
when we see big companies like Ford and GM throw billions of dollars at electric cars, which, we don't want to go down the rabbit hole of, like you said, there's no 100% clean energy or anything like that. So that's not the point. The point is that the big boys are seeing the shift, and some of it is like it's out of necessity, and some of it's like I don't want to be left behind. You don't want to be the last one through the door on some of this stuff. So why don't we'll take a little break, and when we come back, let's talk about you and your relocation to Eugene, Oregon. In my office, we specialize in helping people relocate from all over the country, you being one of them. And I thought it would be fun if we kind of just talk about what that process was like, both just in general and then, maybe specific to your experience working with us and how we were either helpful or unhelpful in helping facilitate that for you guys. How's that sound?
That sounds great.
All right. We'll be right back. Wow. It looks like we're running out of time, and we'll need to air the rest of the interview with Kat Woodman next week. For now, here's the latest installment of Kip's Tips. This week's tip for buyers is do not waste time. Get into the market now. We are seeing interest rates go up pretty dramatically, and we anticipate them to continue to rise throughout the summer. And we also anticipate prices to continue to go up as well. Now, we will see some softening of prices towards the end of the year, but I don't anticipate prices in the Eugene, Springfield, or Bend, Redmond markets to go down. So now's the time, buyers. Get in while you can. Thanks for joining us this week, and we'll see you next week.
Thank you for joining The Revolution. We are over and out until next week, when we'll continue to fill you in on all that matters most in our local Bend and Eugene real estate scenes. See you next time on The Real Estate Revolution.